All right, let's dive right into this. Recently Target came face to face with what is, quite literally, the absolute worst nightmare for any massive retailer. And no, it wasn't empty shelves, it was actually having way too much stuff. We're talking warehouses absolutely pushed to the brink, unsold products stacked literally to the ceiling, aggressive price slashing just to survive, and watching their profitability completely fall off a cliff. But here's the real hook, and it's this wild paradox we're going to unpack in today's explainer. This billion-dollar crisis, it didn't strike during some massive recession or a retail dry spell. Actually, scratch that. It happened directly on the heels of one of the biggest explosions in consumer demand we've ever seen. Target had actually gone out and expanded their inventory like crazy because, well, people were buying literally everything in sight. So how exactly do you go from record-breaking, off-the-charts demand to an absolute financial emergency practically overnight?
Right? That is the million-dollar, or I guess in this case, billion-dollar mystery we really need to solve. How on earth does strong demand actually trigger a crisis? It feels totally backward, doesn't it? Normally, when we think of a business going under or hitting a wall, we picture empty stores and a total lack of customers. But for Target, it was actually their incredibly aggressive reaction to a huge surge in demand that set the trap. It's wild. One of America's absolute retail giants basically went from desperate supply shortages straight into an overstocking disaster so fast, it honestly gave the entire industry whiplash. Products that just weeks prior looked like absolute strategic necessities, the life-or-death items Target felt they absolutely had to have in stock, suddenly morphed into this immense, heavy financial anchor just sitting there in their warehouses. To really get how growth and demand can become so dangerous, we kind of have to rewind and look at the whole psychology of the supply chain during that specific, crazy moment in time.
So just think about the sheer contrast here between what they intended to do and what actually happened. On one hand, you've got the fear. Back during the peak of the pandemic, an empty shelf was the ultimate enemy. I mean, empty shelves destroy a retailer's reputation faster than almost anything else, right? Companies were absolutely terrified that if they didn't lock down their inventory early, you and I would just turn around, walk right out the door, and shop at a competitor. And honestly, that intense fear totally drove the strategy. But then, reality hits. That fear-driven, panic-buying strategy led straight into overloaded warehouses. Target pushed so incredibly hard to avoid those dreaded empty shelves. And at the time, buying up massive amounts of stock seemed like a highly rational, super strategic move. But as we'll see, they were playing a really dangerous game, with variables they simply couldn't predict.
To truly grasp the sheer scale of this misstep, we've got to put ourselves back in that environment. Remember the absolute chaos of the pandemic supply chain? It was wild. Retailers were essentially operating completely blind in a highly unstable world. You had massive shipping delays, unprecedented raw material shortages, and totally erratic consumer demand. Suddenly, everyone is stuck at home, working remotely, completely overhauling their daily lives, and buying mountains of goods to support that new normal. And this created a profound, almost paralyzing anxiety inside global retail supply chains. So Target, naturally wanting to keep things in stock and capitalize on this massive boom, they leaned in, hard. They ordered aggressively, operating on the assumption that this very specific pandemic-era demand was just going to hold steady forever. But here's the thing. Trying to forecast demand during a totally unstable economic shock is incredibly treacherous.
And this is beautifully illustrative of exactly where the whole strategy just totally derailed. It's really the ultimate plot twist of our story. Think about early pandemic spending. What were we all buying? Home goods, electronics, big pieces of furniture, basically anything to make our physical spaces better. And Target stocked up massively on these exact categories. But then, almost overnight, the market just shifted faster than anyone thought possible. As the world started opening back up, our spending totally redirected. We wanted travel, we wanted experiences, we wanted services. And at the exact same time, boom, inflation starts biting hard. Suddenly, households are forced to prioritize essential purchases, just paying for groceries. That extra discretionary money, poof, it vanished. So Target wakes up and suddenly finds itself clutching massive mountains of inventory in those big, bulky, slow-moving product categories from a year prior, while the consumer had already completely moved on.
So watch how this builds into a legitimate operational catastrophe. Because once this ball gets rolling, it is a vicious, unstoppable cycle. First, all those unsold flat-screen TVs and massive patio furniture sets, they just start piling up. And as a result, the warehouses become severely, intensely crowded. And it's not just that the stuff is sitting there collecting dust, storage costs actually start going up. And literally millions of dollars in cash get trapped inside those cardboard boxes. Next, just to clear out the physical floor space, because remember, you still have new, seasonal stuff arriving on trucks every day, the aggressive discounting begins. You have to slap these massive clearance tags on everything just to get it out the door.
Which brings us to the fatal final blow. Your margins get absolutely destroyed. It's this brutal domino effect that perfectly shows how excess inventory actively attacks a company's operational flexibility and just eats its profitability from the inside out.
The absolute core takeaway here is that inventory only creates value if customers actually buy it at healthy margins. Honestly, so many people, even seasoned business students, just kind of assume that having a ton of inventory is always a great thing. I mean, it goes down as an asset on a balance sheet, right? It's product just waiting to be sold. But this entire story proves that is a complete illusion. If products sit unsold for too long, they morph into a massive, heavy liability. Even if Target's top-line revenues still look pretty impressive on paper because they were moving a huge volume of stuff, their actual financial performance was rotting from the inside. Selling a product at a 50% discount might clear up warehouse space, sure, but it generates basically zero meaningful profit. It's essentially empty revenue.
But you know, what really ultimately doomed Target's strategy wasn't just that they made a bad guess about what we wanted to buy. It was the sheer logistical nightmare of when they had to make those guesses. We're talking about the dreaded supply chain timing delay. In modern retail, these supply chains have incredibly, almost unbelievably long lead times. It's not like you can just wake up, decide you need 100,000 desk lamps, and have them show up on a truck the next morning. No way. Orders for those massive, massive quantities are often placed many, many months in advance. And what that means is retailers are essentially forcing themselves to make multi-million-dollar bets based entirely on forecasts. They're banking on a prediction of the future, not actual certainty.
Just watch how this forecasting risk actually plays out in real life. It's honestly wild. So months prior, based on those booming pandemic trends, Target puts together a forecast and places these massive globe-spanning orders. Okay, fast forward to just weeks before the delivery is supposed to happen, suddenly consumer behavior shifts drastically. People stop buying home office furniture and start booking flights instead, right? Now we hit the present day, those massive cargo ships finally arrive, the products hit the loading docks, but the demand has completely, totally evaporated. By the time the physical goods actually showed up, the assumptions that were used to buy them in the first place were completely wrong. When historical data becomes unreliable, exactly like it did during the pandemic, you're essentially making huge financial gambles in a casino that is constantly changing the rules on you.
And that brings us to the ultimate retail dilemma. It's this massive tightrope walk that every single store manages every single day. If you lean too far toward efficiency, meaning you hold very little inventory, you risk lost sales and furious customers staring at empty shelves. But if you lean too far the other way, toward availability, holding way too much inventory just to guarantee customers always find what they want, well, you take on massive operational costs and the huge risk of severe markdown pressure the second trends change. Target, frankly traumatized by those brutal supply chain shocks early in the pandemic, leaned entirely 100% toward availability. But the second the economic weather changed, they suffered the brutal, expensive consequences of ignoring efficiency.
So after all the dust settles, what are the real post-mortem lessons from this entire ordeal? Well, first, we've got to recognize that inventory is absolutely a double-edged sword. It's an asset, yes, but it is also a massive, massive risk. Second, and I think this is honestly the most important piece, forecasting isn't just about crunching numbers and looking at historical data. Fundamentally, it's about predicting human psychology and human behavior, which, let's be real, can change on a literal dime. Third, when markets are unstable, historical patterns become totally useless. Fourth, those incredibly long supply chain lead times we talked about, they expose you to rapid behavioral shifts. And finally, operational flexibility isn't just some corporate buzzword. When you are navigating pure, unfiltered uncertainty, flexibility is literally a survival mechanism.
Ultimately, this whole explainer leaves us with a pretty profound realization about business strategy. Target's big crisis wasn't a failure of not having enough to sell. It was a catastrophic failure of having way too much of the exact wrong thing at the exact wrong time. It totally exposes the hidden, rarely talked about dangers of aggressive growth and the terrifying reality of what actually happens when your forecasting assumptions completely fail. So as you go out and look at how businesses are operating behind the scenes in your own life, I want to leave you with this final, provocative thought to chew on. In the incredibly fast-moving world of modern retail, is holding too much inventory actually a whole lot more dangerous than selling too little?